Covered call funds have exploded in popularity in recent years. I have met many investors who own covered call funds, and they believe that the funds give them downside protection and a measure of diversification. So I thought it would be fun to make a video and explore this topic to see if covered call funds do give downside protection and what type of diversification benefit can we expect if we invest in covered call funds. For our simple analysis, we are only going to look at two variables. Number one, how did some of the largest covered call funds perform in a down year, 2022, relative to the S&P 500 and the NASDAQ 100? Then we are going to look at a correlation data table to see how strongly correlated are some of the largest covered call funds with the S&P 500 and the NASDAQ 100. The funds that I've chosen for the analysis all have a minimum of 10 years of trading history. That's important so that we can get an accurate 10-year correlation coefficient data table built against the S&P 500 and the NASDAQ 100. We need that trading history so that we can see how do these funds compare in terms of correlation to the S&P 500 and the NASDAQ 100 and against each other. That will tell us, do we get a diversification benefit with covered call funds? The funds in this analysis are some of the largest covered call funds from Global X and Eaton Vance. Here's a look at how some of the largest covered call funds performed in the 2022 down market. We see a number of funds from Eaton Vance as well as Global X. I have the S&P 500 bolded here and the NASDAQ 100. And what we can see is that most of these covered call funds like the Eaton Vance Enhanced Equity Income 2, EOS, or EXG, ETY, ETV, etc., performed worse than the S&P 500, but not as bad as the NASDAQ 100. Two funds, EVT and XYLD, performed better than the S&P 500 at minus 12 and minus 17.3. So there is some capability for a covered call fund to potentially perform a little bit better than the S&P 500 during a down market. Certainly XYLD didn't have as bad of a loss as the S&P 500, about 6% difference there. And the Eaton Vance Tax Advantage Dividend Income Fund, EVT, was real close to the S&P 500, but you notice a number of other funds were worse than the S&P 500. So do you get much of a downside cushion with a covered call fund? Debatable. Here is the 10-year correlation data for all of the covered call funds we saw in the previous slide against the NASDAQ 100 total return and S&P 500 total return. All of the numbers that we see over here are very high, indicating that there is limited diversification benefit with covered call funds when compared both to each other and the NASDAQ 100 or S&P 500. Let me show you how to interpret this data table. If, for example, we want to compare the S&P 500, which is line number 2, to the Eaton Vance Tax Managed Dividend Income Fund, ETY, which is line number 5. We would find number 2, drop down to the intersection with 5, and we see it's 0.92. That means that the Eaton Vance Tax Managed Dividend Income Fund, ETY, has a 0.92 correlation coefficient with the S&P 500 over the last decade. They move virtually in lockstep. Correlation coefficients simply tell us the degree to which two investments' prices move together or against each other. Are they moving in tandem or are they moving opposite like a teeter-totter? Correlation coefficients range from +1 to -1. +1 being perfect correlation, perfect linear correlation, and -1 being perfect negative correlation, teeter-totter. So when you see very high numbers like we see right here, what that tells us right away is that over the last decade, all of these covered call funds have been almost perfectly correlated with each other and with the S&P 500 and NASDAQ 100. I thought it would be fun if we included a total return analysis for these covered call funds we're looking at versus the S&P 500 or the NASDAQ 100. If we had invested $100,000 on 1/1/2014 in any of these covered call funds or the S&P 500 or NASDAQ 100, here is where we would be on 12/31/2024. You can see the NASDAQ 100 total return was the big winner, $653,000, 18.6% total return. One of the covered call funds, EOS, beat the S&P 500. EOS had a compound total return of 13.87, finished with $417,000. The S&P 500 finished at 389, and the remaining covered call funds finished below the S&P 500. And a couple of them had pretty low returns of 8%, 7%. That's significantly below the 13% we saw for the S&P 500. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. So let's add it all up. Covered call funds don't appear to give any significant diversification benefit within equities. Covered call funds are going to move up and down just like the S&P 500. It is debatable whether or not covered call funds will give downside protection. We saw that some did and some did not. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.